Hey guys, my name is Grizz and this is the painful truth about inverse fair value gaps. So I know some of the cleanest inverse fair value gaps that you've probably been taking fail, but don't get mistaken, you probably marked it right. It's just the one thing that failed was the bias. A very common mistake that most inverse fair value gap traders take is they're treating them like signals. So some IFVG gap traders are literally taking every single inverse fair value gap, and that's just not the case, especially when there's no bias involved. So when there's a bias involved, that's kind of telling us where market wants to go. For example, we have a 1 hour sweep right here, right? So keep in mind, this is the 1 hour chart, and we see price kind of take this low out. So after price takes this low out, we see the market have this humongous momentum, and we have to ask ourselves why did the market have that huge momentum? So let me go in the lower time frame to show you guys what actually happened. So this would be on the lower time frame, and this sweep right here is kind of telling us in the shorter time frame what actually happened. So market swept it, and we see this massive move up, and that's how we usually enter our inverse fair value gaps. And this play right here is a very strong play, especially in the 30-second chart, because look at this gap right here. We see it close above the 30-second. We'd have our stop loss right below the inverse fair value gap, and obviously we would target this high. So why did this play work and other plays don't work? So the reason this play overall worked is because of the higher time frame, like I mentioned before. So we have a higher time frame sweep. We see these momentum candles going up. That's a clear indicator that market definitely wants to hit this next liquidity zone, or these equal highs that we have up here, which is also an extremely important target that we should all mark out when we are entering trades. I want to show you guys another example of a trade. So in this case, we do have a sweep of liquidity right here. I mean, it looks like market wants to go down, right? Especially after moving so high up. That's where my mind would probably go. However, look at our higher time frame. So in our 15-minute time frame, we see a sweep of liquidity. So after seeing the sweep in the higher time frame, I'm expecting market to probably most likely hit this high, right, in the higher time frame. So now going back in the lower time frame, why would I be looking for shorts if I'm thinking in the higher time frame that market wants to go up? So that's why, as we can see here, let's just say enter this short, put our stop loss above this high, and then obviously target maybe this liquidity. Let's see if this play actually works out. And just like that, play did not end up working out. Why? Because the market wanted to go higher based off the higher time frame. So this is a point that I want to drill in your guys' head, is that it doesn't matter if the lower time frame is giving us a very bearish reaction. If it doesn't align with our higher time frame, don't take the trade. And that's why a lot of unprofitable traders fail. So let me show you guys just one more example of why bias is so important and how you guys can avoid more mistakes. Going into our 12-hour chart, we see this sweep of liquidity, right? So with that being said, I want you guys to always remember this and instill this in your brains. The higher the time frame, the more likely market is to respect these liquidity points, or even any PD array, which is like an inverse fair value gap, a fair value gap, an order block, a breaker block, all these things. Price is most likely going to respect these levels. So here we have an order block. Notice how the market came down, tapped the order block one time, came down, tapped it twice, and then also couple that with the sweep, and we're definitely going up. So now we could use the 12-hour to our advantage, maybe go into the 4-hour. We could see a sweep in the 4-hour. So what is that telling us? That's telling us market definitely wants to probably hit this high over here. So now we just keep on going down the line, go to the 1-hour. We have an inverse fair value gap in the 1-hour, and notice how market actually respects it. Couple that with the 12-hour, the 4-hour sweep from earlier, and we see market kind of running up these highs. Now let me show you guys what actually happens. And yes, looks like we are going to end up hitting it. Yeah, just like that, we hit these highs. So that's when you know the market is kind of influenced by these liquidity points. And the reason that is because of the hedge funds. So the hedge funds and the banks and the government, even, they put their money at these lows. So when the market hits these lows, they buy in a bunch of buy positions, because they know a bunch of people are going to get stopped out. And that's important for us to capitalize on these buys, and that's why we use the inverse fair value gap strategy, because it basically capitalizes on the hedge funds, the banks, the big government, and all of the people going in the market. Just think about it. We just want a piece of the cake of this entire big move up. So with that being said, if you guys are actually serious about being profitable, I actually have a Discord in the link of my bio where you guys can actually join, and I actually have a pretty awesome community where we can actually all keep each other accountable. So I hope to see you there.